you can strategically use long-term option contracts to significantly increase your upside potential while dramatically reducing your downside risk. I mean, like taking a stock that would have a 1-to-1 risk-reward ratio, risk-reward profile. That means 1 down to 1 up. And by using these contracts, making it more like 1 down to 5 up. I'll explain everything. I'll show you how coming up. Hey there, my name is Steven Spicer, and it's my goal to help you invest smarter. If that's what you're looking for, hit subscribe now, and then make sure that the notification bell is on so that you don't miss any of this valuable information. Now, this video will be building on the detail and example-packed video that we just released, exploring the basics of options, as well as how to profit from and when to use covered calls. If you missed that one, you really should start there. I'll link to the playlist in the description. Long-term call option contracts are actually technically called long-term equity anticipation securities, or LEAPS. They really forced that acronym. Since I'm assuming you've already seen that last video and now have a decent understanding of how call options work, figuring out LEAPS is going to be a cinch, even easier than covered calls. When we're writing covered calls, we're selling the option contract. And we do it with only 30 to 45 days until expiration, since, as we talked about last time, that's when the time decay is increasingly working in the seller's favor. Your favor, when you're the seller. With LEAPS, we're doing the complete opposite. We're looking for contracts to buy that have a year or more until expiration. That's pretty much it. It's nothing super tricky. It's not even some combination of stock and option like we did last time or like we'll do next time. It's just a plain vanilla call option with a super long period until expiration. Now, not every stock has them, and this isn't a strategy where you would go sifting through available LEAPS to find a really good deal. None of these strategies in this series are like that. You might use this strategy if, after you've identified a good value opportunity, you then discover that LEAPS on that particular underlying stock are available to trade. Then would be the right time to consider whether using LEAPS or using the underlying stock itself would create the best risk-reward profile for your investment based on your analysis. Here's the mindset where you might find LEAPS the more attractive option. Your thesis, derived from your detailed research and analysis, of course, suggests a significant upside potential, say 100%. But the downside risk, even if you view it as less likely, is also significant, say 100%. The catalyst, or two, that you've identified that will cause the stock price to move one way or the other will most likely occur in the next year or two. Of course, you're tempted by the massive upside potential, but that downside risk, even if it is far less likely in your opinion, doesn't sit well with you. LEAPS, if they exist for the stock in question, might be the perfect way to play this position. You see, when you buy call options, the premium you're paying is essentially made up of two parts. One, interest, and two, protection. The interest you're essentially paying is on the dollar value of the stocks you control with your contracts. So if your contracts expire in a month, the interest will be relatively small. You won't have the rights to those underlying shares for that long, so it stands to reason that you'd pay much less. However, if you're talking about having those rights for, say, 24 months, like we are in this example, it makes sense that the premium would be quite a bit greater. You can think of this like interest you're paying for each additional month that you control, have the rights to the underlying asset. And the second part you're paying for is the protection. If the stock price crashes, for example, the holder of the option contract isn't exposed to that. The person holding the underlying shares is. You're only risking this initial premium. So any amount above the interest you're paying could be thought of as your downside insurance premium. So in the loose example I gave earlier, by using LEAPS, you limit your downside risk to the premium you pay, while still being exposed to much of that significant upside potential. Let's get greater clarity by adding some numbers to this example. XYZ stock is trading at $50 today. There is a public concern of potential bankruptcy. You conduct a thorough deep dive, like what we walk through step by step in my value investing course, and discover some solid evidence to suggest that the media has it wrong. That within a year or two, when the smoke all clears, it'll be obvious that XYZ is solid and should be trading at a price that is at least double where it is today. There are obviously some unknowables involved. You could be wrong. The company could actually be headed the way the media is portraying. But you don't think the chance of that is near as high as its price and trend would suggest. As Joel Greenblatt says, of course, I never invest in situations with complete certainty anyway. Situations that make sense and offer attractive returns given the risks involved, that's all I can really ask for. So there is risk, but if your research-based thesis is correct, the price could easily double. The upside potential of just straight up holding XYZ shares is 100%, but there is also that nagging case for a 100% downside as well. So you could weigh your conviction against that risk-reward profile to determine if buying XYZ stock makes sense. Or you could check to see if there are LEAPS available. Let's say you find a LEAPS contract with an expiration that is 2 years from today with a $50 strike price. Its premium is, say, $10. Now let's play through the scenarios. The catalysts that you had identified that would cause the stock price to either crash or surge at some point happen in those 2 years. If the price surges to $100, as you expected, you could exercise your option and immediately net $40 per share on the entire trade, because you could buy the underlying shares for $50 and then immediately sell them for $100, the market price at that time. And then when you subtract out your initial investment of $10 per share, you realized a 400% gain on the money you had exposed. If, on the other hand, the underlying stock crashes, you're out $10. Whereas if you'd had the stock, you'd be out 5 times that, $50. Pretty cool, right? Similar upside potential with way less downside risk. And those of you who have been with me for a while now know that that combination is music to my ears. One more quick example that I hope might help. You could think of it like this. Using the setup from earlier, what if I offered to give you a loan today to buy shares in XYZ? I tell you that, of course, I'm going to charge you interest. I'm going to ask for it all up front, and it'll be a little higher than you might see on other loans, but not as high as credit cards though. Part of the reason the interest will be a little elevated is because of the extremely attractive bonus feature of this unique loan. Specifically, if things don't play out as you're expecting, you don't need to refund me the principal. You don't need to pay me back. Can you imagine a loan like that for anything? A business idea or investment opportunity, whatever? It'd be crazy, right? But if you thought there was a decent chance that your business or your investment would succeed, well, you'd be crazy to not take those ridiculously advantageous loan terms. Well, the dynamics of LEAPS, although not technically a loan, they're essentially setting up for you this uniquely advantageous deal structure. You pay the one premium on the front end for the right to profit from the trade if all goes according to plan, according to your investment thesis. But that's it. If things go south, you're not on the hook for anything else. You see how you're able to pay a relatively small premium in order to leverage control of a much larger asset? Now, I'd only recommend this strategy when the psychology of the trade is as I described, where the issues should be resolved within the allotted time period, 1 to 2 years, where there is significant upside potential, and, although not an essential criteria, it makes even more sense when on top of all of that, the downside risk from owning stock outright might be a little bit more than you're willing to take. One final additional benefit to this is the way LEAPS are taxed. That is, if you hold it for more than a year, which you probably will with LEAPS, any gains you realize will be taxed as long-term capital gains. This is obviously unique for an option contract, as they are usually pretty short-term vehicles. Once again, I hope your investment wheels are turning and you can see the incredible benefits of learning more and mastering these strategies. Don't forget to subscribe so that you don't miss the next one. Until then, I'm here to help. I hope you say hi in the comments. I wish you all the best. Take care.